So today I'm here with Don Wake, who is an associate broker with HomeSmart in Phoenix, Arizona. And he has been in the real estate business for 15 years and is a self-proclaimed data geek. The reason I wanted to talk to John is because I was on his website and he's done the most fascinating chart, this real monthly mortgage payment house price index, something I'd never seen before. And we're going to talk about that in a few minutes. But first, give us the nutshell of what happened in Phoenix after the 2008 bubble burst, because you guys were a really hot market. So how did that play out? And then how is it doing now?
One of the things is we are a contagion market from you all. Well, I guess you're in Reno. That's not exactly it, but we're a contagion market from LA. I had all that internet, so I had a lot of LA clients, and they tended to, since there wasn't that much online back then, and so a lot of them, they were investors in LA, and they thought prices were too high, so they went to Las Vegas, and then the prices got even high there, so they came here. So it was that addition, including the normal people buying and selling, to have those people from LA come in really made the prices skyrocket. And once they start skyrocketing, then it doesn't really matter if the price is high. People think, yeah, this is a crazy high price, but it's going up so fast, who cares? So that's kind of where we were. It didn't matter if the price was grounded in reality or not. As long as it's been increasing fast for the last so many year or so, then people would buy. So that's what happened. And then we were one of the biggest busts. Our boom was towards the end, but it was straight up. And then we had one of the biggest busts because the laws in Arizona, it's easy to foreclose. You can foreclose fast. It's not like New York or New Jersey or Florida. So we really felt like the median home price for the whole metro area fell 60%. And there were, oh my gosh, there's some zip codes, it fell 80% from the top to the bottom. So then it slowly worked its way up and then became hot. In fact, the last year, the last couple of years, we were incredibly hot. Phoenix was the hottest market in January in the whole country. We was up like 11% from January to January. Part of it was interest rates were low and the economy was strong. A lot of people were moving into Phoenix. One thing that happened in 2008, there was a year or two there where the population, in fact, fell in Phoenix, which never happened before. And then we slowly ramped up. And in fact, the in-migration into Phoenix has been really strong. And so that's a lot of it too. It's just people moving here.
Tell me what happened after COVID hit this year.
Well, first it was shock. What does this mean? And people were kind of in denial. And then, but the market really tanked. It's kind of what is typical throughout the United States is the sales went down, which people kind of expected. But the thing that a lot of people didn't expect, I didn't certainly expect, is the number of homes hitting the market. The new listings really fell. They were down, they kind of bottomed out last month in the middle of the month, but they were running maybe 40% less per week than a year earlier. So we had this balance problem where people were thinking, okay, there's going to be lower sales, so price will go down, but there was lower homes hitting the market too. So in fact, the market's a little bit tighter now than it was last year at this time because there's so many fewer homes hitting the market. So that's kind of what's happened. There's still a lot of homes for sale, and my big concern is, are there a lot of homes that are going to hit the market soon? Are those people that didn't sell, are they going to put it on the market as soon as they feel safe? Or are they just people because of employment or whatever reason decided, okay, we're just not going to sell right now and move up or whatever, we'll just stay where we are?
So your buyer demand has stayed pretty consistent then through all this, or it dropped along with the listings still?
It dropped along with the listings, but not as much as the listings. Okay. So overall, like in January, we had a super tight supply, crazy tight, like in 2005 supply in month supply. And now like it was like 1.6 something month supply. So we're still below 2 months supply, even despite this COVID. And 2 months is crazy low to begin with. So that's where we are. What's going to happen in the future, no one knows, but we're starting to move up again. There's starting more homes hitting the market. Sales are going up. So things are going in the right direction. But how long are they going to go in? Is this going to go on for a year, or that's the question?
Well, that is the big question, and that's the one I'm always trying to figure out. I enjoy a good speculation. I know we don't really know the future, but I'm always trying to read the tea leaves and kind of get a sense of where things are going. And so, in my area, I see, and a lot of other areas, I see this pent-up demand because people have been locked up for 2 months, and we had come into this season really strong, and then all stop. And now we're seeing a lot of pent-up demand, and I think we're going to have a really busy summer. But the thing is, how
Yeah.
long will this go on? Because, if there's a second round of COVID outbreaks and another lockdown, although I don't know that the economy could survive it, but, how is that going to impact the housing market is what I'm trying to figure out. Do you think the housing market is going to crash?
Oh, it's definitely not going to crash because the supply and demand are so in balance right now. Just as a tidbit, I was looking at numbers from 2005. From the summer of 2005 till December 2005, the number of homes listed for sale doubled in Phoenix. And then in the next 6 months, it doubled again. And then that's a sign. And prices hadn't even started falling yet at that point. So if this turned out to be a huge deep depression, it would be a year or two before prices started to fall anyway, but I don't see it being such a horrendous depression. We did see one of the things that happened when we first was the question is how far is it going to go down? How deep is the problem? Now we're beyond that. We know we've bottomed out and we're going up. So now the question is how long and how fast will things improve? So a lot of people are saying it'll be next year. But for us, like in Reno and Scottsdale, there's speculation that maybe people would prefer to have a vacation home. So the demand for second homes is a little bit higher maybe than it was before COVID, a place they can escape to when things go wrong. So
Yeah, definitely. I've seen a couple of interviews with the Redfin CEO talking about that, thinking that he's got the advantage of having national search data. And he's seeing a lot of searches happening in places like Boise and Charleston and Madison, Wisconsin. And it's people in the cities that are searching in these smaller towns. When the Twitter CEO says, hey, you don't ever have to come to work again, you can work at home forever, then, it's like, well, why am I paying all this rent to live in San Francisco with the homeless people everywhere, Why don't I move to Tahoe? But, then there's the other side that says, 36 million unemployed people, some of those jobs aren't going to come back.
Scary.
Yeah, I mean, it's just a lot of people are predicting a depression, and that there's going to be all these unintended consequences, like when they can't pay their rent and then their landlords get in trouble, and and how far does it go is what I'm trying to figure out. And it's too early to tell probably, but that's just what I'm trying to figure out.
Yeah, I'm cautiously optimistic that it won't. For housing, one thing, an advantage compared to 2008 is housing then was the center of the problem. And now we're kind of strong. We're okay. We're just being wrapped up with everyone else, but we're not the cause of the problem.
Well, let's talk about this amazing chart that I saw. I thought it was so interesting. I was Googling for something, and your video came up that you did recently that was related to this topic. And I'm like, oh my gosh, it's John, and he's ranking in Google. And so I clicked and it all, listened to it and went to your website to check out the charts that you've done. There was this real monthly payment house price index that it looked like you created. I mean, like you went deep into Tableau and made this incredible interactive chart. And if I'm interpreting it correctly, it looks like when you adjust everything for inflation, when you're talking about real money versus 1990 versus 2020, in terms of monthly payments, it's actually cheaper now to buy a house than it was in 1990. Is that it?
It's crazy, but that's not what I expected to find, but that's what I found. Because typically when you look at home prices, it's common to adjust for inflation. So I had been doing that for years and years. And I knew when interest rates went down, that would save the home buyer who takes out a mortgage, that would save them some money, but I really didn't know how much. So I'm thinking, John, you really need to figure out, is that a little or a lot, and how does the change in the interest rate make homes more affordable? Put it into numbers instead of just the concept. So that's what I did. I just took basically in 1990, the interest rate was 10%, and now it's 3 something. So what did that mean if you borrowed $100,000 in 1990 and borrowed $100,000 now? How is the payment different just because of the interest rate change? So I decided to add that into, so adjust the home prices for not only inflation, but the changes in the interest rate, both things. And it was pretty revealing. I think it explains the market so well. And it also explains to me why we're not going to have a real estate bust. The prices aren't way out of line when you look at it that way, when you look at the mortgage payment price. So here's the idea is like, when the interest rate goes down, it lowers your monthly payment, but how much? A little or a lot or over time? How has that affected the market? So the blue line here is the 30-year fixed mortgage rate. It was on about 10% in January 1990, and now last week it was like 3.3%. So what does that do to your mortgage payment? Well, this is what shows that. So if you borrowed $1 or $100,000 and paid 10% back then, your mortgage payment today would be 51% for that same dollar. That's the principal and interest. It's not taxes and insurance, but your principal and interest is half of what it was in 1990. So that explains why people can pay more, or why the house at the same price is a lot cheaper than it would be. So you can go down for, here's Los Angeles. Well, let's go down here. This shows you the price in LA compared to 1990. It's almost 3 times. But if we adjust for inflation, it's only 43% more than it was in 1990. But if we also take into account the mortgage interest rates, it's actually cheaper now than in 1990. But 1990 was the real estate bubble. It was the top of the real estate bubble. So that would be bad if it was 100%. But nevertheless, it's a lot cheaper than it was then. So that just gives an idea that when you take into account inflation plus the mortgage rate, the prices aren't crazy. But it also explained to me why prices have gone up so much is when the interest rates are going down, people can afford to pay more. So over time, they bid up the prices. And that's a super common economic idea that when interest rates go down, that stocks, but also houses prices go up because people can now buy with the same monthly payment. They can pay more, and eventually they do. So if rates go down a little bit, within a couple, 3 years, house prices have gone up. So they're not that cheap anymore because the prices have gone up, even though the interest rates are down. And here's the final one. Here's the showing all the different cities. I can do all the cities here so you can compare the different ones. And right here, this is looking at San Francisco. And it does explain better to me the market. You had this huge S&L boom, then the bust, etc. This boom here was when the .com boom, everybody was moving to San Francisco, then things weakened a little bit. But prices are going down here too because interest rates are going down. Then we have the real estate bubble, and prices ended up being lower than they were in 1990 because not only were the home prices going down, but the interest rates were going down, which added to a really good buying opportunity.
And one thing you said that was interesting, I think it was in your blog post, was that for a buyer, the best strategy is to buy right after interest rates drop, before it's priced into the houses.
Exactly. That's totally true. Like right now, one effect of Corona is interest rates have gone down. So if you get in now, that would tend to, there's other things going on, but it would tend to have home prices go up because people can now pay more. They can actually buy a more expensive home with the same monthly payment. And as time goes on, that tends to bid up the prices for those homes. But it's not something that happens in a month. It happens in a couple, 3 years that the prices get bid up. So now I would say if you were thinking of buying now, well, interest rates are going to stay low. It doesn't really matter. But if interest rates were to go up again, then now's a good time to lock it in.
Truly, I thought that was a novel way to look at it.
To me, it seems like it's so obvious. It's like almost as important as inflation. In fact, it's about the same effect as inflation. It seems obvious.
It incorporates inflation, but inflation, people don't think about except in terms of prices going up. and we don't think about the value of a dollar in 1990 versus now, other than it doesn't buy what it used to. But, in conjunction with the interest rates and what you're really paying in terms of those dollars, that was like,
Yeah. Yeah. One thing I didn't mention it because it's kind of a downer is one of the downsides of having the lower interest rates is people tend to have bigger mortgages because the home prices are going up. It's been great. It's been great for the boomers because home prices have been going down. But now for the millennials, they're not going to have that tailwind. The World War II generation, they ended up doing great because of the great inflation in the 70s. Because suddenly their mortgage payments just tanked because of inflation. It was a fixed rate mortgage. So they did great. And then we didn't expect to do great, but we did good because of the declining rates. I don't know what's going to happen to the millennials, but it could be that they're going to have a lot of debt and it's not getting inflated away and the interest rates aren't going lower, so they can't refinance. So those poor millennials, well, maybe something good will happen to them too.
I think they're kind of bitter about it too. There's a lot of them rooting for a housing crash.
Yes.
And I get it.
20 years from now, they'll have more debt, real debt, than we did or the World War II generation. So I guess it's good if you're a bank.
Yeah. But if you're paying less money now than you were back then, I guess that was a question I didn't ask. Does the price really matter? I mean, does anyone ever pay off their debt? I mean,
that's the argument. No one pays off their debt. I guess they did. I guess the World War II generation did, because it would be remember there'd be like a party when somebody paid off their mortgage. But now, I think that's one of the problems. There's a lot of people retiring who still have mortgage debt, which is a lot more than in 30 or 40 years ago. So now that's not so good. It'd be nice if you didn't have mortgage debt when you're retired.
Yeah. I don't know. We almost need a debt jubilee. It can't go up forever, and you can't just make money out of thin air forever. I mean, there's going to be some resolution, and is it going to be some big bang, or is it just going to be some slow, painful 20-year situation? I don't know.
We could have inflated. If we did get big inflation again, that would help the millennials. But right now, it's looking more like it's going to be deflation, or maybe deflation for a while, and then we had this enormous national debt. But inflation would help them.
Yeah, inflating it away is certainly.
Oh, if you already owned a home, it would help you. Only if you already owned a home would it?
Load up on debt, right? For your house, right? Have some gold on the side, right? Wait for the inflation to really take off. And then when the dollar's worth very little, you take the gold, which is now worth a lot more, and pay off your loan, and boom, you're free and clear. That's my big trade.
That's good. Or maybe you tie in a 3.3% rate now.
Yes.
And then we get inflation at 7%, and you're golden because your payment is tanking.
Yeah. Well, I don't know. We can only hope. All right. So it's been great talking, and thanks for joining us. We appreciate you watching, and we'll see you next time.
Thanks so much, Dan.